Welcome to Market Call. I'm Morello Fernandez. Bill Harris on the show today. He's president and portfolio manager at Avenue Investment Management. He'll take your questions on Canadian dividend and resource stocks. Here's how to reach us. 1-855-326-6266 if you'd like to call in. You can email your questions as well today. marketcall@bnnbloomberg.ca. Bill, thanks for coming in. Good to see you.
Yeah, thanks for having me on.
Let's talk a little bit about what's going on. We have Donald Trump still talking tariffs, putting a 50% tariff now on copper, a 50% tariff on Brazil. When you are looking at the market these days, are you trying to work around the tariffs and things that could be tariffed, or are you trying to look past that?
Right, great question. And then, so for Avenue, and our strategy is always saying, just don't be like the target or the bullseye. And I even go, my best example is, there's all sorts of strategies in Indian stock market where you're a moth and you just want to go to the flame. Mm-hmm. Our idea is let's try to find a great business that everybody's ignoring. And so try to find the things that are not going to be affected by tariffs. And so when Trump was elected in November, he's talking about tariffs. Why don't we go through it in November and see how all of our businesses would be affected, and probably so far the one impacted the most is CP Rail, which we own long term. It's it's something that can't be replicated. They get monopolistic profits, and we go, will we take a hit? We have, and the stock has actually gone relatively sideways, and it has been reflected in the price. And it looks like, so I'm just updating through that. It looks like the way the stock is even performing in the last couple of days, it looks like we're actually almost beyond tariffs. It's all in the price, and now the market is looking through that. But for the most part, try to go where parts of the market that are being ignored, not just going right at tariffs and I'm going to try to figure out the tariffs. It's too hard to do. It
must be hard, though, to take a look at the stocks and try and determine what's going to be hit and even by how much, because Donald Trump really is all over the place, right? He puts them in. Sometimes they're high, then he retracts, then you get a month of a lull, and then he decides again he wants to try something else. So has anything surprised you that has sort of come out from the tariff in Washington?
So far, it's not all that, it hasn't been a direct hit. And I think it also, when you go and analyze what the stock market looks like. So one thing, let's go through our individual businesses that we own. And again, we invest in these very specific companies and we try to be a long-term investor. And how does that affect? That's one. Now, we're still in a stock market, so let's analyze the stock market. And when you go through them top down, and Andy was just talking about, bank stocks and making new highs in Canada, just like there's a lot of things that aren't affected by tariffs. The overall economy might get softer, and it looks like it is, or the consumer might be affected, but that doesn't affect Microsoft's earnings. So whether the big index stocks in the U.S. or big index stocks in Canada, how does that affect Brookfield? And that's really just all about the interest rates. So probably much more important than tariffs and how this impacts auto manufacturers. 100%, it's going to affect auto manufacturers. Brookfield is set by the 10-year bond yield. And so how this all plays through, and then the budget is way more important, how it affects 10-year bond yield, and then how that affects the stock market than what tariffs are doing. So I think this is why the market has, digested tariffs so quickly, is that tariffs have a specific impact on this little part of the stock market, but not the big picture.
Got it. Okay, we're going to take a quick break. Bill Harris with us today of Avenue Investment. He's going to take your questions on Canadian dividend and resource stocks. Here's how to reach us. We're back in a moment. Welcome back. We're going to start with an email today from Jerry. He says, I would appreciate the guest's view on CNQ, so Canadian Natural Resources. I haven't looked at it today, but what's your take overall on CNQ?
So when we had an incredible shakeout in the energy stocks in around 2016, then we had a massive rally, and the expectation about 2 years ago was energy is the place you have to be. And so all the stocks in general have been sliding since that point. And where we are, and just think of CNQ being our big Canadian oil stock, and oil right now, so we just had our tariff, conversation. So tariffs are slowing things down and gumming things up global supply chains and shipping and transportation. So incrementally slower, and OPEC is saying, oh, we want to increase production into this slowness. Usually that does not happen. There's a dislocation. There's sort of thinking that, it's not even conspiracy theories, that there's an idea that the U.S. would like to have CPI down, which is oil prices down, so they'd like to have as much oil as possible, and encouraging oil production in the U.S., but encouraging the oil price to sit where it is right now means there's not a lot of drilling going on. So the two things that are happening is that there's too much oil right now, there's too much oil going into the fall, but oil has a way of tightening itself up. If the price stays down longer, there's more, drive to get that price higher later. So right now, CNQ is where we're getting our about 5% dividend yield. It is the stock we want to own in Canada for this exposure, but knowing that we're going to have to sit here, but it's at a relatively good level, and then we believe that the oil price will be higher later, and it's hard to time that, but CNQ is going to be the one we can sit here, collect our dividend, and be there for when the oil price goes higher later. But is there any catalyst why that's going to happen even in the next 6 months? It doesn't seem like it.
Okay, I was going to say the high for CNQ was last year, I guess, in October. It was up at 51.71, and now today we're down to 43.22. So you're saying it's going to be at least 6 months before we could see that turnaround?
In the energy price. Now,
yes.
if it was the first quarter of next year, stocks tend to move 6 months ahead of time, so we just don't know.
Got it.
So, but it does seem like with all the geopolitical stuff going on, is that it's going to take time. You can also get a geopolitical event, where just oil, Iran just gets gummed up, and you take 2-3 million barrels off the market. There's always those geopolitical shocks. But right now, the way the world is going, is there's enough oil out there.
Would it be a better time then to step in now because you have the lower price? If you already own it, perhaps buy some more?
Yeah, well, so this is the whole thing. Is just, yes, what we would like to do is own it when nobody wants it, and the story is negative. So this is a great theory right now, is that, and we would, when everybody wants it, is when we'd be selling it. When I can tell a story, just there's too much oil in the world, and it's not a great story, this is when we'd buy it and collect our 6% dividend while we wait.
Got it. Okay, let's go to the phone lines. Andre is on the line. He's calling today from Chilliwack. Hi, Andre.
Oh, hi, Morella. Thanks for taking my call. Good to be first up. I haven't called in a while. Mr. Harris, could I get your thoughts, please, on Kushtard? I'm a loyal shareholder. I'm in the house of pain with it. It's underperformed. It's under the 200-day moving average. The street doesn't think it can pull off the deal. What do you think? I would maybe even sell it. I hate to say goodbye to it, but there's a lot of things that are doing much better. Your thoughts, please, and good day to all of you.
Okay, thank you very much. So there is an opinion,
right,
and I want to know if you share it, that they have bit off more than they can chew, trying to get the 7-Elevens from the Japan owners who don't seem really like they want to sell, or that at least they're dragging their heels.
Right.
Do you think this deal first will get done, and do you think that they perhaps bit off more than they could chew?
So we've owned Kushtard for a long time. This is one of the fantastic Canadian compounders over time. But it will also go through a period where it can go sideways for a couple of years and digest. And this is great. So they've got this high rate of return business in their core business, and then they're going to take their free, this free cash flow, and maybe they'd even leverage themselves and get more of these businesses around the world. We would be of the opinion that it's when they tried to buy that massive French grocery store, and we didn't like that one because it was really outside of their comfort zone. This would, if it got through, it would be great because there's synergies they could do. If they didn't get it, that would be great because they just buy their stock back. So we think that the market doesn't know what to do because of all the uncertainty. It's coasting sideways. It's still a great business, and now it's really consolidated at a long-term moving average. It's relatively inexpensive to where it's been historically. And so if this gets sorted out, it's again like CNQ. You're waiting for your catalyst, but the catalyst isn't now. So for us to say the business is done, the core business is done, that's terrible, but it's not, that's not what's happening. The market is uncertain for other things, so if you sell it here and then it goes and doubles because there's nothing wrong with the core business. But last point on that, though, we do own it. What has been softening when we talk about tariff effect in the overall economy, we're having a mild consumer recession in the U.S. depending on your income level. And so that affects your energy drinks and cigarettes and all that kind of stuff. So that is right in the sweet spot for Kushtard. So the numbers are a little bit weak right now. But again, knowing all that, knowing can we get through that in a year or two's time, we're still going to sit on this as one of our core Canadian holdings. That it's got this incredible ability to compound internally.
Okay, so hold, maybe even buy a little bit more if you have been a long-time holder of
Yes.
Kushtard. Got it. Okay, let's go to Mark. Mark's on the line today. He's calling from Milton, Ontario. Hi, Mark.
Hi, your thoughts on Air Canada? Do you have a price target for this? It's had a bit of a run-up here. Would you be taking money off the table if you had a gain on it? Thanks.
Okay, thank you for the question. Air Canada is always a hard one because the business is tough, and they're probably benefiting today from Delta coming out and saying they're moving forward with their guidance. But what is your take on Air Canada?
Yeah, we don't own it. We have owned it at certain points in time where the numbers are extraordinarily compelling, and they're just not right now in terms of really transparently understanding where it can go to. So we would stand back on this one. And transportation is particularly difficult. I would also say what's very interesting that the trade talks where, again, I'm talking about when you go and look at the index. So go and look at the U.S. index, and it's those really 7, 10 big stocks that drive everything. Canada, when you go through the index, you go, oh, it's these restricted businesses that drive everything. Anything that's left in Canada has these walls around them. Banks have walls around them. Cameco has a wall around it. Tech B has an A-B share structure. It actually, Kushtard has a share structure. So when you look at Air Canada or you look at the telecoms, in this trade dispute, what's really interesting is this stuff might come up and be on the table. And we're talking about, can a U.S. airline fly into Winnipeg, fly back, maybe I actually want to go over to Calgary and come back. And it's interesting that that's sort of gossip at this point. And so that's very... The dynamics of the Canadian market might change dramatically. And if I'm remembering off the top of my head, Air Canada makes most of its money, like that margin, off of the international flights. So we just don't know where this is going to be, and there's enough and where the stock is, there's enough uncertainty that we wouldn't buy here.
Yeah, more details today that Canadians are still not flying to the U.S. for their vacations.
Yeah,
right?
I didn't touch on that.
That's the other side of it. Fewer people want to go there just for fun. Okay, we're going to take a quick break. Bill Harris is here today. He's with Avenue Investment Management, taking your questions on Canadian dividend and resource stocks. Back in a moment. Welcome back to Market Call. Thanks for joining us. Let's go straight to the phone lines. Mark is on the line from Ottawa with a question for Bill Harris today. Hi, Mark.
Bill, I'd like to ask you about Canadian Tire. I've held it for a long time, just collecting dividends, and that's about it. I made a little bit there as of late. Time for these guys to leave the rink, or what's going on with these guys?
Okay, thank you for the question. I think it was cutting out a little bit, but basically Canadian Tire, I'm wondering how much they would benefit from the Bay closing, right? Bringing in the Bay sort of products that won't be sold anywhere else. But they're at 189 today. We have 189.34, so they're up a little bit today. But generally, how do you like the retail space? Yeah,
again, this is really tricky. Long term, exactly where caller said this fits in, that if you've owned this great Canadian business and they've really gotten very efficient how they retail, we would say that are we going to have a consumer recession? Mm-hmm. Is there, interest rates? This is something that might happen. It's not happening right now, but it's something we're concerned about. So Canadian Tire isn't something we'd rush out, and there's nothing that special about it right now. But long term, just to own it for 10 years and click the dividend, and is it going to be a better incremental business? It certainly all fits in that category. It just doesn't necessarily meet the threshold that we're looking for, and just really concerned about the consumer and how all these tariffs are going to play out, and how here's our relationship with the U.S., where all our Canadian stuff comes from. Is it coming from China? Is it coming from the U.S.? And we just, if we can't figure it out, then we tend to stay away from it. Same comment I made before. And just if I got just one quick sentence on this. Historically, I've come in for like 20 years and talked about mid-cap, large-cap Canadian stocks. I sort of specialize in resources. And so the only thing that I'd say which is different in the last year is inside Avenue's portfolios, we're trying to build this high income type portfolio. So what we're trying to find higher dividend paying stocks and resource stocks is where we're finding this opportunity right now. And so I'm specializing on that. And our growth names, which I can talk to all day long, but sort of saying, if there's a question on that. But Bryden Teich was on, I think, two days ago for the breakfast show. He's specializing in that in Avenue. And I'm really trying to specialize on this. And we'll talk about our pick names, the top pick later for today. Yeah. It's really specializing in trying to say, can I build this high income portfolio engine inside our long-term strategy?
Interesting. Okay, we'll get there towards the end of the show. Let's move on to Rose, who's calling from Cambridge, Ontario. Hi, Rose.
Hi there. Hey, Paul, I'm one of those people that watched you a long, long time ago when you were the resource guy. And so I'm calling in for your information today on Timber Creek. You've recommended it in the past, and it sounds very unique and like it's an alternative kind of investment for me that's used to just banks and pipelines and boring TSX type of stocks that I've held for a long time. I would like I'd like high income, and I'd like something different. Do you still like Timber Creek? Thanks a lot, Paul.
Okay, thank you for the question. Timber Creek at 763 and down about 9.5% over the last 5 years. How well do you know Timber Creek?
Intimately. There you go. Not to go too far that way. But currently we own Timber Creek. We also own Atrium. So these investment acronyms, which I like to get around, that mix, they're called Investment Income Corps. Okay. And so this is just a pool of money that trades on the stock exchange. And they take that pool of money and they invest it in short-term mortgages, first and second mortgages. And when asked, what's the rate of return going to be? Going to go, I don't know. But I'm going to get 100% payout of the money, of the income that they lend on those mortgages. So hopefully that pool of money stays the same, and then you just collect the income that you can get based on the interest rate. So you see that dip in Timber Creek, and earlier this year it was down to sort of $6 or so.
Yes.
It's got a net asset value, so the value of the cash on the stock exchange is around this is off the top of my head, but I think it's $8.25. Okay. So that is the value of, like, you just wind everything up, give everybody the cash back, it's $8.25. So traded at a big discount because it's in the real estate market, commercial, residential, real estate. Mostly it's residential and apartment buildings that are fully rented. So right now there's worry about that asset, and sort of the stock traded at a big discount to its cash breakup value. And every time we talk to the company, they say it's difficult, but we're working our way through it. And so now I can capture that income stream that investor is nervous about, and I have the upside that if it all works out fine and we get flat. And so far it looks like it is working out. And so when you have a distressed asset, you're able to sell it into the open market. And still the big difference right now, and spending time this morning looking at it, a corporate borrower, even in the 5-year time frame, is able to borrow still like 4%. Like, interest rates are low overall. They're higher than they were a couple of years ago, but they are still relatively, or in absolute terms, low. And so real estate is transacting depending on what type of real estate you have. And so Timber Creek got caught up in the sentiment of that. And so we still think it's underpriced where it should be long term. You're able to capture the income stream, plus there should be a capital gain if you're patient. So very much part of the portfolio.
Got it. Okay, let's go to another caller. Jim is on the line from Peace River with a question. Hi, Jim.
Hi. I was wondering, with Senovas, I liked them a lot better when they were at $28.50. Why have they come off so much?
Okay, thank you for the question. Is this just sort of energy prices that have taken the hit that has brought Senovas down?
Oh, that's tough. It's exactly the way it's the right question to ask. And why is Senovas there's a few things that are specific to Senovas. Okay. And we talked earlier about C&Q, just the whole industry right now, specifically oil, specifically Canada. Everything is just kind of drifting, and there's no real catalyst. Suncor has gone through a whole process of just restructuring, cleaning things up. Senovas is trying to do that as well. I think they've actually been transparent about it, and you're able to pick up this great company. I keep looking at it just like on the next 2 years, 3-year basis, like they are going to make an awful lot of money. And remember, the last time we had, high oil price, we actually had a high Canadian dollar. Now we have, even if the oil price is sitting, $65, $70, WTI, they get heavy oil price. But the Canadian dollar is so much lower. They've still got these great margins. They're throwing off lots of money. You're just able to get this, very high quality Canadian business. It's not when an international investor goes, what do I want to buy? Well, C&Q tends to be the first one. That's why, we own that one. And you go down the list, and C&Q's a couple stocks down the list, and they're just sliding and they're just getting cheaper, even though they're still making all this money. So
and you said there are a couple of reasons for that beyond the price of oil. Is there anything specific that you're seeing?
No, I think that there's historical operating issues, and they're all being addressed. And so, but it got put in the penalty box from that, and the company is showing that they're being addressed. But certainly, the stock is just. It still is going to throw off a ton of money, and they're just sitting there really inexpensively. And I noticed now, not on the large cap side, but there's a lot of stocks that are a level down from that, very specifically, that are now doing things. And when you do the things, do one thing right, like Trican did an acquisition, boom, the stock goes up. So you can't sit there and wait, saying, well, I'll wait till it sort of breaks out or something. The moves, when they do move now, are pretty dramatic on the other side. So if you own it, there's nothing wrong with it. Like I said, we're living in C&Q when we go through this, but Senovas would be on that list.
Got it. We're going to take another quick break. When we come back, we'll have a look at Bill's past picks. Stay tuned for that. Welcome back to the show. We're going through past picks now from Bill Harris. This would be from March 11th of 2024. At the time, Bill, you chose Atrium on the TSX. They are mortgage lenders. Is this a stock you still like?
So this last section, when we talked about Timber Creek, we owned a bit of Timber Creek and also Atrium. Atrium is a little bit more conservatively positioned than Timber Creek, going through this part of the financial, this interest rate cycle. And so absolutely still own a core position. And again, there it was even trading at a bigger discount over a year ago. So you've collected 8-9% dividend, plus the stock is up 10%. And it's just, you're not trying to shoot the lights out. You're just trying to accumulate that income and then go and reinvest and reinvest and reinvest as you go along. So yeah, it's a great part of our long-term strategy.
I should mention it was a 1% return and then a 14% total return for Atrium. Let's get to your second pick from March of last year, which was Osisko Royalties. So they do sort of metal royalties, gold, silver, that kind of thing. At the time, it was $16.10 US. It has gone up to $26.71 US, so a 65% return and a 67% total return. What have they been doing over the past year that has brought them up so much?
Yeah, everybody likes gold now. So you got to go back over a year and a half. Now, this wasn't quite the bottom. And so in Canadian dollars, we originally bought the position at $16 Canadian, trading at NAV, growing 30% over 3 years. Really like the management. All those things are in place. I still go back, a little over a year ago. Man, did people hate gold. Like, gold is never going up again. Everything's about cryptocurrency and the internet and AI. And so, but the way our the worry about debt and the worry and the rest of the world, really that story of China's accumulating gold, and the Far East, all that is now clicked in, and it all seems obvious. It wasn't necessarily so obvious. We will always have an allocation to gold. Cisco is really one of our main. We own Wheaton and Cisco, and then we'll always have a smaller, I'll talk about it today, a company. So just our hard asset gold businesses. But man, it's incredible the difference between a year ago. Like now it seems obvious. A lot of that growth came right
in the last few months.
Well, the gold has gone up. And so ironically, even though how inexpensive it was now, when you have a gold royalty business, it's still trading a little over 1 times NAV. I think it's 1.2 times NAV. When you have the Wheatons and the Franco-Nevadas, they will trade almost like 2.5 times NAV. But so this is cheaper on valuation, still growing. They also had a mine incident in the last year. The Eagle mine went down, so 5% of their NAV, and now there's gossip that the Eagle mine might come back too. So there's a nice catalyst that for
so
earnings
moving
there.
Forward. Got it.
Yeah.
Okay, let's go to your third pick from March of last year, Superior Plus on the TSX, SPB, which does propane. Is this a long-term hold for you guys as well?
From an income point of view, you're trying to find a really stable business, and the cash flows they distribute propane. Quebec gets really cold, unless they get propane to keep the lights on, and so it's that type of thing. But they've gone distribution all over the U.S. and they've also bought this compressed natural gas business. So being very humble about this, great, loved it for a long time, but we don't own it forever. They sort of the mechanics of the stock got messed up. Nothing that happened that much in the internal business, so we actually got stopped out of it because it's a stock that went from even like 12 was higher than $12 at one point, right down to $6. And it's one of those, the stock market terms, they had to find a new shareholder base. And you just go, you should just cut the dividend and you just buy your stock back. and the company went and did it. So we actually reloaded again in our income portfolio at about $6, and now I think it's over $8.
Yeah.
And so weirdly, from this time place, it's flat from when we little bit down from where we talked about it, but it's still a very consistent business. And now they've found a new group of shareholders that are willing to go with them, incrementally grow it, and it's just going to become a buyback machine.
Let's go to the board for a moment. I did not get a chance to read it out. So it was at the time $9.85 last March when you recommended it. Now at $8.16. So as you mentioned, it's come back from the low. But overall, a 17% downside for return and a total return a 10% drop. But you're saying you bought in again at the low and you're going to hang on to it.
Yes, in the dividend part of the portfolio.
Got it. All right, we're going to take a quick break. More of your phone calls and your emails when we come back. Stay tuned. Welcome back. Let's go to the phone lines. John has been holding. He's calling from London, Ontario, with his question. Hi, John.
Hi, Marilla. Hello, Bill. My question's on Whitecap, which just merged with Varen, the former Crescent Point, thereby realizing economies of scope and scale. Most price targets for this stock are in the $12 to $14 range. The dividend is handsome. What is the chart telling me, or what does your analysis tell me about why Whitecap is only just starting to approach those price targets? Thanks very much.
Do you like the Whitecap Varen deal?
Yeah, this is great that how this consolidation. Actually, this is the story. I don't want to go on too much of a tangent, but if we, so we got lots of time today. I always remember when I started as an analyst, 25 years ago, is that you had to know as much as you could know about 20 stocks, and then the way that 20 stocks in Western Canada, and then that spreadsheet comp sheet blew out to about 200 names. Try to know a handful of things about most companies, and I would have said due to the consolidation when this really started, it's coming up in 10 years ago, but like 8 years ago, is that you were going to see consolidation, and industry gets older, but it gets more efficient, and you should probably go down to there's a handful of companies, and so that would have been a theory. And does it make sense? Yes, and now you're actually seeing it happen. And you can go out and start a new company if you want, but it gets harder and harder to do that and how many teams and plays. So it's much more interesting to watch the industry consolidate in bigger companies. But I don't think there's I'm not the person to sit here and say, so there is a catalyst in terms of a deal and efficiencies, but this play is going to impact the stock. It's much more, we'll look at the overall numbers and your sustainability of being able to repeat that, that compounding inside your company. Whitecap does a very good job. Again, just for that oil exposure, we'll be in C&Q in Western Canada. We want to be in the bigger, higher, not necessarily high quality company, but if the market moves to it, it'll move to C&Q first. And then Whitecap would be on that list of 5 companies that would be below C&Q. We don't own it right now, but we would, depending on what the makeup is. But I would say from the caller's point of view, if you can be patient, all of the businesses look like that. It's like the Senovas, Whitecap, slightly smaller. You're just being patient because this is the way I've had it explained to me if I talk to a trading desk in Calgary. Just like anybody who owns Whitecap or wants to own Whitecap owns it already. So where's that incremental buyer going to come from? And there's no catalyst about the industry. So you have to say, I'm just going to own it. I'm going to collect that income. And hey, there might be a scenario where, yes, they get the efficiencies, the stock goes into the mid-teens, or the that investor that's not normally invested here comes back. But you just have to be patient. But because of the valuations on these things, it's really compelling to do it at this valuation. Allocate some money to this, because this is such an anomaly of saying we get this energy price, we get the dividend, and there's a reason why these can be higher later.
Got it. Okay, let's go back to the phone line. Glenn on the line from Calgary today. Hi, Glenn. Glenn, are you there? Okay, we may have lost Glenn. He did have a question about Nutrien, if we want to take a look at that chart. Nutrien started moving up after quite a long low period, but at the start of the year it started climbing up. It's had some dips and is down today What's your longer-term outlook for Nutrien?
So I'll bring up this one with point, because we've talked about tariffs so far, but I haven't talked about this one point. What's really interesting when you're going through Canadian businesses and just sort of go how much trade goes back and forth. And again, the example is always brought up, that auto part that goes back and forth like 8 to 10 times while you're assembling. And there's other businesses that actually have cross-border businesses, but it's like standalone in the U.S. and standalone in Canada. And so Nutrien actually falls much more into that category, where it's technically should be affected, but it's actually not. And so it got inexpensive. It would be on our list. There's only so many stocks we can own, and we did miss this one. It had right when it was at the low. The other problem that we have with it is that it is actually a really capital-intensive company, and it doesn't get as high a rate of return. Not too much technical jargon, but as high a rate of return on capital as we would like, as to some other businesses are. And so, again, if we're worried about yield going forward, it's something that might get caught in that, even though that's not happening today. You know, I said the overall interest rates are low. Agriculture, we were in a bit of an agricultural depression, but it looks like it's going to work its way out. And even just off the top of my head, I looked at John Deere, the stock price this morning, and John Deere was up. Just even a little breakout. So it's very interesting from an agricultural point of view. Money is going and finding those things.
All right, let's go to the next caller. Then Nelson is on the line. He's in Toronto. Hi, Nelson.
Oh, hi there, Billy. I'm hearing a rumor that Quebecor might buy the Canadian operations of the CCA, and Comcast would buy the U.S. assets. Your thoughts, please. Thank you very much. I'll hang up and listen.
Okay. Are you hearing anything similar like that?
No. Okay, that's a great question. I will read about these things once it becomes a note, and I don't know, and that would make sense, right now we occasionally will own those. We tend to get stuck in these stocks. I was going to, not to completely shut that down, the numbers are actually at those two smaller telecom groups are actually pretty good right now, almost compelling to move, but not enough. We've owned. Years ago, we owned Bell and had a great run. The numbers sort of broke down there. That's very much discussed on a daily basis here, and how you have to cut the dividend because it's just not the underlying business isn't making there. Wireline is declining. The only thing right now is that, so we moved a few years ago to TELUS just for the yield. And as long as the stock doesn't go down, don't expect that much from it. But we've been able to capture that incremental yield, and we think that they're able to clean up the business, clean up the balance sheet, and that is happening. And even then, I read a note last night that it looks like you can actually increase pricing on cell plans incrementally. So we just want that to happen and capture the income. And so because there's so many of these other moving pieces around with Cogeco and Comcast and these things, is that the one that we think is the clearest is TELUS. And so it's not to dodge that question, but if it's something, again, we can't figure out, I don't have any direct knowledge of that, and it would certainly be healthy for those businesses, but those businesses haven't been as good numbers as compelling for us to move from TELUS to them, because we think we've figured out TELUS here.
Got it. And we should add that, of course, Bell Media is the owner and runner of this channel, to the Bell Media brand. So BCE, the stock there. Let's go on to Nazar, who's calling from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Mariella. Hi, Bill. May I have your thoughts on Manulife Financial, please? This Lifeco is range-bound between $42 and $44. Would you categorize this Lifeco as an income stock with minimal growth? And if I may, would you please compare it to Sun Life Financial with similar yield? Thanks for taking my call.
Okay, so thank you for the question. We have Manulife at 42.11 today. It got up to, in April, 46.35 during that big dip. But what's your take on Manulife?
Yeah, it's had a good run here. I'm going to go back and defer to my father on this. And
okay.
I've over 20 years, I brought him up occasionally, and he only passed on bits of information to me. But his experience with, analyzing these companies and working at them, and just when you're trying to look deep inside Manulife, it is such a complex company. It is really hard to figure out. I would even say now that Brookfield falls in the category, and even banks, like there's just so much going on inside them. It's really hard to say this is what's going to happen. So we would look at it and say much more from this type of business, can we get it relatively inexpensive to expectations? There was a point in time a few years ago that they fell in that category. We only have so many slots. We ended up buying a property and casualty insurance company to life insurance. That's Dividend. That's done extremely well for us, just like much more rifle shooting in that sector. So we haven't owned either a Manulife or Suncor. And I always have that voice from my dad in my head saying, even if you tried, you're not going to be able to figure it out.
Yeah.
And so, that I know that's probably not a helpful question.
Well, I'm just wondering, too, because of how complicated some of these financial systems are, does that make you stay away from them?
Yes, we just stay away. We can't figure it out. So we will own clean banks that we can. We own National Bank, the most profitable bank in Canada. Royal Bank's got this incredible franchise. And so, that's just on the banking side, and then we own one insurance company to it. That's just how we build financial pocket around, financial services. If you look at the numbers, and then the only other thing I would say is just because I still look at them all the time, if you put Manulife and Sun Life beside each other, Sun Life right now is incrementally more profitable.
Got it.
And a little bit cleaner in terms of what they're doing. And so, but right now there's nothing compelling about the price to what the valuation is, where you'd sort of say, I can't even figure it out, but I know it's a deal. I'm getting a deal. It's not at that level. And then incrementally, probably liking Sun Life over Manulife.
Okay, we are going to take a quick break. We'll line up more of your phone calls and your emails for when we come back. Back in a moment. Welcome back. Let's go to Chris, who is on the line from Calgary today. Hi, Chris.
Morning. My question is with regard to Brookfield Corporation. That's BN. It's an all-time high right now, and I am a shareholder. But I'm wondering where the stock is going to go from here, and will it go up? The dividend's about 0.6%, which is no reason to really hang in there. Thanks a lot.
Okay, thank you for the question. We have Brookfield at 87.32 with that dip in April, like everything else. Is this a stock you guys own?
We don't own it currently. And again, it's just not meeting our financial matrix. It is, again, we just talked about Manulife. And if you want to look at, complexity on steroids, that's Brookfield and Brookfield Group. If it was inexpensive enough, we owned it a few years ago when it had this big discount to net asset value, and it still trades a little bit in that world. It's really hard to own and to understand what they're doing. I would also throw back to the caller, it's just saying, if the world, I haven't touched on this yet, like the stock market right now, just like, why does the stock market keep going up? Well, because the U.S. hasn't done anything about its budget deficit. It's $2 trillion more in the financial system. Then you're doing that with low unemployment, and you say, but haven't you issued $37 trillion worth of debt? And you go, you're jamming it all into the Treasury market. If it all goes into the banking system and the Treasury market, there's just tons of money in the financial system. If there's tons of money in the financial system, Brookfield can do what they do all day long. Also, the idea is just like what's going on in the Middle East and Singapore, just like if they've got money, excess money, and they need to put it in infrastructure around the world, Brookfield is their man or person. Sorry, it's an incredible Canadian success story for doing what they do. But you're putting it up against the Blackstones of the world and the Carlyle groups and understanding what this type of business is. And so, again, if we can get it inexpensively enough, there's other things we're doing right now, but just understanding when you own it, it's all about global liquidity, which is just that really soft, like nothing financial term. What is global? There's all sorts of ways we try to measure liquidity, but there's just money in the financial system. Brookfield does great. And if it tightens up, and we still worry that by the end of the year or next year, interest rates go higher, liquidity comes out of the market, Brookfield really struggles. So it's really to think about it those way. We don't own it right now. If it was a compelling, we would. And it's just, if I pass on anything, it's just, we try to measure liquidity, and Brookfield is even one of those pieces of liquidity. Just say, how much liquidity is the market? Well, watch, what is Brookfield doing?
Okay, let's go back to another caller, our last caller, I think, for the day, Catherine from Vancouver. Hi, Catherine.
Greetings to both of you. Bill, I have been a keen follower of yours since you first recommended Alta Gas at $6. Could you tell me your thoughts on Alta Gas, please?
Okay. thank you for the question. We've got about a minute for Alta Gas.
Yeah, we owned it through this last move, not here. Just it sort of pulled off, and again, worried about interest rates longer term. The stock I'm going to talk about in a few minutes, just in terms of our infrastructure story, we think is slightly more compelling valuation. And again, the hardest problem we have is we can only own so many stocks. There's here's this little box, and we try not to trade them. And so Alta Gas is great, and it was super compelling valuation a couple of years ago, and now it's fair. There's nothing wrong with what they're doing. Great regulated businesses, the mix of businesses that they have, but there's nothing that fantastic. If I owned everything, yeah, you probably wouldn't sell it. But right now, we're shifting to something else.
Got it. That something else is coming up
Yes.
in your new top pick. So stay tuned for that. Bill will share those after a break. Stay tuned. Time now for new top picks from Bill Harris. His first one is Pembina Pipeline on the TSX, currently at 49.72 is where I have it, a little bit down today, but dropped overall overall the start of the year, took that deep dive in April, came back a bit and down again. What do you like about Pembina moving forward? So
again, this is with the idea of building income into the portfolio, also trying to buy something that's a little bit out of the spotlight and where there is a catalyst. So, and again, everything is sort of bad news right now around Pembina. So you're getting, it's 5.5 yield? I can't remember, it's about 6%.
Do you not have it off the top of my head?
And so the Alliance Pipeline, very special asset going from Alberta to sort of the Chicago area, and it's one of the only pipelines where you can get liquids through the pipeline system. So it's a very special thing. They've got contracting issues, living through contracting issues with Enbridge trying to change it. And when you're going through it, if the stock market doesn't know what's going to happen, the stocks can slide. And but we believe that still, if you're looking at a year or 2 years from now, these issues are fixable and they will be knowable. They're just not known now. So here's a high quality Canadian company, lots of prospects. And there's a lot of things we like about it where they just don't issue shares as much as the other companies do, keep a really tight business plan, and we believe it can incrementally grow over the next few years. So even though I don't know if it's going to go up right today, it looks like it actually might come off a couple more dollars. We've got two pieces. We've bought one position, and if it drops again, we would actually add to it, not get stopped out of it. And so it's just saying this is a special situation, and this is what we're doing right now. Got it. Okay, let's get to your next topic, which is Tourmaline Oil. What do you like about Tourmaline? So this is excellent that it says Tourmaline Oil because it's Tourmaline natural gas. And so there's the story that should move the stock is there's an idea, and it's starting to incrementally happen. We've had this incredibly low gas price, just too much gas in the system. Canada, some days where there's just no bid for gas, like down to $1. And so there's an idea that by 2026, not that far from now, you might actually get a tighter gas market. Tourmaline's been incredibly successful Canadian story, and so if this was to happen, and having done this for as long as we've done this, we have to own something. And so Tourmaline right now, a little bit, they've had special dividends that have oversized versus the current dividend. Okay. They've actually said that right now the current dividend yields about 3, and they're going to issue special dividends equivalent to that amount. So whether we're going to sit here in this stock that the production is growing, we're going to get 5 to 6% dividend while we wait, like the C&Q story, and with the catalyst that we really hope in the next 12 months, 18 months, you could actually get a tight gas market for the first time in a long time. Are you counting on the fact that we're now pushing gas to other countries like Asia? We're getting those ports up and running? All of the above. Okay. Yeah, it's really happening. It happened now. And then the dumb thing is, like, if I missed this, having done this that long. So there's there's a few of these commodity walls that are out there. There's a copper wall that's out there. There's a natural gas wall. So we really want to own something. So again, but Tourmaline falls in the highest, category of the highest quality company we can find while we wait for this to happen. Got it. Okay, let's get to your third pick, Oz Gold, which is a miner out of Australia. And I think they just focus on Australia. Is that correct? Yes. So we would own, in the gold space, wanting to own hard assets and owning businesses, not just owning bars of gold, but we'll have our 2 royalty companies, and occasionally we will rifle shoot over the years, I've talked about, we had a very successful investment in Redback. We had a successful business in Roxgold. And so we'll have one of these at a time where you've found the resource and you're building the mine, and the stock tends to trade at a discount when you're in that period. And these are, not all, but a couple of the Roxgold people have gone to Osgold. We wouldn't normally do this to you, but I'm talking about what we are doing. And so we try to stay in North America. There's lots of choice, but we know the people. It was a great asset. We're going to build a mine in Western Australia. And they came out with the feasibility study recently. Also, they just did the financing. The stock is knocked down on financing. So even talking about it today, I feel comfortable saying even at this price, you know, you're going to be able to sit, in a year from now, you'll have much more transparency as they go ahead, build the mine, put this thing into production, and there's high probability that they will have more gold through exploration by the time the mine is actually put into production. I think I'm still using exit 2027. Okay. So in the gold mine, you've got to think a couple of years. To buy something at a good price, you've got to buy it a couple of years ahead and imagine what's going to happen, you know, a year from here, 2 years from now. But we think that the Roxgold people that have moved to Osgold, they've set it up for another great success. Okay, good to know. So Osgold is one to look into if you're looking to expand outside of North America, which many people are right now. Well, it's also just gold. Like, this is the whole thing. You're just buying gold. Yeah. And where are you buying it? Got it. All right, Bill Harris, thank you so much for joining us today. Appreciate all your insight on this. And thank you for watching us today. Market Call will continue tomorrow. Have a good afternoon. We'll take a look at the markets as we head to a break.